Hello everyone, welcome to our example, you might say, of inventory and how it plays out in our accounting equation or T accounts. So we're going to do it in the T accounts. You can certainly, and we want to be able to do the journal entries as well. This is a good model for working through homework problems, that sort of thing. A little different than the example of how you might lay it out in the textbook, but it emphasizes the T accounts and how they would look as we go through the process. So we're going to start in this problem with inventory left over from the accounting period before. We're going to have that in our inventory T account. That's 15 items that each cost $9 in the inventory to begin with. Okay, so that is our beginning inventory. You notice it doesn't match with our others. It doesn't balance because we're focused on just a couple of accounts here, and so there would all the other accounts would have to, if this were a full example, this would all of the accounts would balance. But in this case, we're just focused on inventory. So we're going to start with purchasing 50 items for $10 a piece. So if we're going to buy it on credit and there's credit terms, that means that we're going to pay for it later. So we're going to take 50 times 10, well, it's just 500. That's going to debit our inventory and credit accounts payable. And that's how we purchase things on credit. We paid shipping for this entire shipment, $25. All right, so the cost of these items right now is $10, but when we get the shipping, remember that's included in the cost. All right, so we're going to debit inventory, and I warned you that inventory is a default in the perpetual method. And we credit cash because shipping companies often will not give us credit. So we're going to pay. We have $500 to the people we bought it from, and we're paying the shipping right away for $25. So we must have done an FOB shipping point, right? Because otherwise we would be paying the company for shipping typically rather than a separate company in this case. So then we made another purchase of 100 items on the 5th of October. Okay, so we're going to take 100 times. We're going to debit inventory and credit accounts payable again, just like we did with the first purchase. And then we had our shipping that we're going to pay for in cash, just like we did the first time. All right. So you might say that these units cost us $10 per unit plus 50 cents for shipping. So $10.50. These units cost $9. The ones in the beginning, we have 50 that cost $10.50. And then we have these other ones that cost $10.50, but we had shipping on top of that. Okay, so those are actually $10.80, right? As you think about $30 for shipping all 100, that's 30 cents an item. So we have three different inventory. Remember, we're going to make an assumption when we sell it, all right, as to which ones we're actually selling. Okay. Now we're not quite done yet. We got to pay our bills. We owe our customers, our suppliers, $15.50. All right, and we're gonna take 2%, right? Because we get a 2% discount for paying early, and so we're gonna take that $10, $1,550, and multiply it by 0.02, right? $31. We're gonna take a discount of $31 when we pay for this. Okay, so we're going to pay not $15.50, but we're going to pay cash of 1519, which is 1550 minus 31. We're going to pay the cash. We're going to debit 1550, whoops, to the accounts payable, because we're going to make all the accounts payable go away because we're going to pay all our bills. And we're going to use the $31 to reduce our cost of the inventory. Okay? So instead of $10.50, okay, we're going to take off 2% of that, which would be, let's see, 1050 times 0.02. Let's see. $0.21. So this is going to be $10.29 a unit. And this one, I'm going to take 2% off it. I'm at 22 cents. All right, we'll round that. And so we'll get $10.58. So we have now, with that change in our cost because of the discount, we now have 15 unit items that cost $9. We have 50 units that cost $10.29, and we have 100 units that cost $10.58. So we're going to sell the items for $19 sales price. We're going to sell 110 of those. So remember, that requires 2 entries, recording of the sale and sale recording of the cost of goods sold. We're going to do the sales first. 2090, and we're going to go ahead and do that for cash. It would be to accounts receivable. That's not our focus here for 2090. So we've got half of the sale recorded. Now we need to know what cost of goods sold is. So if we do a FIFO assumption, we don't know which ones we sold, but we assume that we sold using the FIFO assumption, then that means we're going to sell the oldest ones. So the oldest ones are always the ones that are in the beginning inventory, right? So we're going to sell 15 items that cost us $9 a piece. We're going to then sell 50 items that cost us $10.29 a piece. Okay, that's 65. That means we need to sell 45 more that are going to cost us $10.58. So we go ahead and multiply those out. And then add them up, right? So we multiply the number of units we sold times the units. So we're coming from the oldest to the newest, right? So we sold the 15, we sold the 50, we sold part of the 100, and we have 55 of the 100 left. Okay? So we're going to have left and each of those are going to cost us $10.58, right? Because that's what group it came from. And so that's going to equal $581.90. So we're going to make our journal entry here to cost of goods sold, debit, just like whenever we sell something, inventory, and we're going to credit Now let's do our usual calculation on a T account, and the inventory, of course, is our focus here. We're going to sum the increases, add the increases, right, and subtract the decreases. Okay. And we got a little different than what we thought we would because we're rounding these numbers. Remember, we rounded that off. Okay? So that's why this is 582 and this is 583. Off by, $1.50 because of the rounding on the costs. So that's how you would do that. Now, let's say that we had to consider lower of cost or market. Let's say that these 55 left go a long time without being sold. And so we're looking at those saying, the only way we're going to be able to sell those is to sell them for less than $10.58, right? So let's say that we find someone who's willing to buy them, not for a month or in the future. They're going to buy them next month, but they're willing to pay us $7, and we just can't find anybody else that will buy them. Customers aren't interested. There's something wrong with them. Okay, after the or maybe something damaged them or something like that. So we would record a reduction of the inventory, a credit to this inventory, to get this number down to what the $7 we can sell it for, times how many units we have left, 45, right? And that would be a debit to cost of goods sold, credit to inventory. Now, if we're using the FIFO assumption, then our sales is $20.90, and the cost of goods sold is $125.6. So our gross profit is, okay, so it makes a difference. We'll see. Okay, so that's our FIFO. All right. So let's do a LIFO assumption. Now here's the thing. The other parts stay the same. All the purchases, all of the discounts, all of that kind of thing, all those journal entries stay the same. So that should stay the same. Cost of goods sold, okay? Only thing that's different is the credit to inventory and debit to cost of goods sold. So if we were to use a LIFO assumption, when we sell 110 items for $19, the sales price is still the same. Still sell sales in cash for $20.90. But when we sell the newest items, the last ones in, that means we're going to sell 100, right? Because what's the newest ones? These ones right here, right? The 100. And that is going to be $10.58. And then we're going to sell we still have a 10 more, right, that we sold, and that would be $10.29. So we start with the newest and we go backwards. Now that's why it's so important where the sale happens, the date of the sale. If the date of the sale would have been, say, October 3rd, then these would have been the newest items. But because we did it on October 10th, these are the newest items. Something's happened since then. So our cost of goods sold would be $1,160.90. So that would be a credit to inventory and a debit to cost of goods sold. So under LIFO, our sales would be 2090 cost of goods sold, okay, would be 1160.90, and our gross profit would equal minus the cost of goods sold. Sales minus cost of goods sold. We would have 55 left, but they would be which ones? Okay, they would be 15 of $9 and 40 at $10.29. Add those together, we get $5.46. You see we were off another $1.50 again between inventory and our calculation because of the rounding. All right, then the last one is weighted average. I'm going to come over here to do my calculations. All right, so getting rid of again, all of the journal entries are the same, okay? How much we paid for it, liabilities, all that good stuff, sales. We just need to know what the cost of goods sold is. All right, so we need a weighted average. This is how we get the weighted average. In this T account right now, at the point that we make the sale. So we would stop, figure out what this total was, add up the increases, subtract the decreases, and we would get 1709, because guess what? I've got Excel calculating it for me. Okay? That 1709 is the balance in the inventory. Then I come over here to my units and I say had 15, then I bought 50, and then I bought 100. So that's a total of 165. I haven't sold any yet because I'm doing my first sale. 65. 165. So I take the total cost, 1709, divided by the 165, and I get that number. I'm not going to round it, okay, in this case. Okay? So I'm going to take that and multiply it by how many I sold. So I just get one number, and that's how much, okay, I'm going to multiply by the number that I sold. And so there is my journal entry. And debit cost of goods sold. Gonna do a little rounding there. Okay. Well, that means I'm gonna have 55 left, right? I always have the same number of left, and that's going to be 55 times, and you can see that we got even closer there because we didn't round, okay, to 569.6667, okay? And it equals our inventory. So that's how we do each three of the methods. That's where the calculations work. And as you go forward, if there were more purchases and more sales and stuff for the weighted average, you would have this $10.36 would become your cost. Just like we said up here, the $9. If we go forward to the next month, this $10.36 would be the cost per unit for to carry it over to the next month or next accounting period.